The GMR Group, quarter four for them was pretty healthy, but multiple one-offs impacted the quarterly performance. Vivek Iyer caught up with the ED Finance and Corporate Strategy, Saurabh Chawla of the GMR Group, and started by asking him about the quarter gone by, but more importantly, the company's target for FY24. Let's hear this conversation.
I think fiscal year 23 was a very good year. It was coming off the back of COVID, and we saw substantial improvement in our operations. If I were to adjust for the one-offs in Q4, our EBITDA was up by almost 81% to about 540 odd crores. And for the full year, on an adjusted basis, our EBITDA was up to 2,118 odd crores, which is up by about 71% year on year. So FY23 was a good exceptional year, but you need to actually correlate with the pre-COVID levels, and hence I would say now in fiscal year 24, obviously we will be building upon this tailwind and the momentum that we have in traffic as this business goes forward.
So you've spoken up a little bit about, how traffic has returned. Talking about Delhi Airport specifically, what is the traffic as well as volume pickup that you've seen since FY23, and how have the trends been in Q1? We understand, the travel has been back with a big bang, but we want to understand the clear trend of volumes. We did see the May updates, but can you give us some more light or some more color on that?
So for Q4, the traffic at Delhi was about 17.7 million passengers. Which is about 49% year-on-year growth, and this trend continues in the month of April and May. In April and May, together, the traffic in Delhi is up 19% Y-on-Y. So the trend line is positive. The momentum continues to be positive, and as I said to you earlier, many parts of the world which were shut recently, as they open up, this traffic momentum will continue.
So just coming to the total debt on books, you have done a couple of corporate actions. So how is the debt picture looking like post the fundraise via the FCCB route, and what will the debt picture look like post the merger?
So as you are aware, our debt, corporate debt, which was always an issue because there were no stable cash flows to support the corporate debt. The corporate debt was about 9,000 crores as of December of 2019. As on date, that debt stands at zero. And actually we are sitting on cash of about 573 crores at the end of March of this year. At the end of April, because we have paid substantial portions of our corporate debt from the FCCB raise that we did from ADP. So that issue is behind us. As we had articulated, we have created capacity for growth at the corporate level. Post the merger, airport entities will be only at the next level of the listco, and hence there will be efficiency of evacuation of cash through dividends. Hyderabad is at a head start because of low revenue share, but Delhi also in some time will start to declare dividends, and both a delevered corporate balance sheet plus flows of cash flow from the airport entities automatically will create substantial amounts of free cash for us to reinvest in new airport opportunities as we go forward.
So you spoke about the merged entity, you spoke about new opportunities, and within the merged entity is where our next question lies. We want to understand, number one, give us a breakup of the revenue of operations in the merged entity. What is the breakup, especially between the aero and the non-aero business? That'll give us a sense of how to evaluate the business going forward.
So on a merged entity basis, on a consol basis, the aero business actually contributes 26% of the revenue, and the non-aero business contributes about 65%. That's the broad breakup, while commercial property development contributes about 9%. As we go forward, while aero will continue to contribute as a percentage, but the growth that we expect will be more on the non-aero side of it, because as I was alluding to you earlier, the increased disposable income in the hands of the consumer is what we really want to tap. People who are going through our airports, we want to tap as much as possible their spend at the airport. So growth of the non-aero, which in the past has been around 14-15% on CAGR basis, that's how this business will grow.
We want to also understand, you've spoken about increasing the share of the non-aero business. Talk to us a little bit more about your ambitions in the domestic market and the domestic businesses, and which are the key sectors that you're targeting, in order to go ahead and increase the revenue share there.
We are in the airport sector, so as and when the new airports are privatized in India, which has been stated by the government, we will surely participate in those privatizations and increase our share of the airport business. That is something which is already there. On the international side, we continue to look at airports in Southeast Asia specifically. So Indonesia, Philippines, Vietnam, Thailand, these are destinations where we see opportunities come by, and we will surely tap into those opportunities at the right point of time as and when those governments open up for privatization.
So finally, please leave us with your guidance that you have given for FY24. What internal targets are you working with? So revenues, EBITDA, as well as bottom line, what can we expect from GMR in FY24?
So we refrain from giving guidance to the markets. We allow the markets to decipher themselves. But all that I can say is that the business has a lot of tailwinds. As India's macro story continues to grow and gather momentum, aviation sector will be much better off. And I think you can get some sense with the current orders that the current airlines, whether it is Air India or Indigo, have put in the marketplace, will give you a sense as to where this market is going. We are probably going to be the second largest aviation market in a short period of time, a very healthy market, and airports have to support the airline businesses. So the more aircrafts are up there, more passengers will flow through our airports, and that's the best part about our business.
Okay, all right. That's the word coming in from GMR Group, but it's also time for